see the slide on the screen? Can I? Okay, Bismillahirrahmanirrahim. Maybe some of you already gone through this example, all right, and straight away can understand. So it's still okay, all right. We just go through, okay. So this is about the new contract, okay, contract sponsorship, all right. The value of this new project is 10 million, all right, 10 million ringgit. Okay, so straight away, okay. So I assume you all then go through the question. All right. So this is the cost of the investment. Okay, cost of investment, 10 million ringgit. And then this is for the project, right, for 2018. I signed the contract with Football Associations of Malaysia as premier sport wear sponsor for teams of Super League Cup for the year 2018. Right. Nike will issue. So this is what Nike will do. Nike is planning to obtain the external fund, and this external fund, right, can be obtained via the combinations of issuing of bonds, right, issuing bonds, preferred stocks, and common shares. So these are the three financing component that are going to be used by this company. Okay, look at the first one. Okay, I just summarize. Let me summarize on the whiteboard, I guess, which is better lah. Okay, and in the meantime, you can refer to the slide while I'm summarizing the information. Okay, now we go to the. Hold on, this is another questions. Okay. Right, you can see the white slide, right? Okay. Now, so the financing component. Okay, financing components here. The first one, the company plans to issue irredeemable bonds. Right, so this already mentioned in the previous lecture where, right, if we want to calculate the cost of debt, we have to identify first, right, whether the company is issuing redeemable or irredeemable. If it's an irredeemable, that means this bond has a feature of with no maturity period. That means this bond will be held by the bondholders infinity or indefinitely. So that means they are going to receive the interest from the company indefinitely. Okay, right. So therefore, the calculations of the cost of debts, right, will be easier. Okay, which is the formula is the annual amount of interest, we just divide by the price of the bond, current price. But since here the bond is issued with the flotation cost of 20 ringgit, so that means this company is going to pay or incur flotation cost. Therefore, the company has to use the denominator of the net price. Okay, that means that price must be deducting the flotation cost first. Okay, for the second one, okay, before that, the interest amount is, okay, the interest is 8%. That is an interest rate. Okay, the par value. Okay, par value, this is the information that you need to highlight first. Par value of the bond is 100 ringgit. And then this is irredeemable, we already highlighted. Right, and then what else? The current market price, current market price of the bond is 110 ringgit. Is it 110? Yes. And the par value is 100. So what does it mean? This bond is issued by the company at a premium. Why is that? Because the price issued here is higher than par value. Right, if the company issue the bond at a discounted price, that means at a discount, that means the market price is going to be lower. So this is the premium bond, since the value of the bond is more than par value. If it's less, that means it is a discount bond. Okay, another types of financing component that is going to be used or issued here is the stock equity. For the second point, this is about preference shares, okay, or preferred stock. So it is stated that the preferred stock is selling or trading at a price of 120. So this is the current price of this particular preference shares, right? 120 means it is trading at 120 ringgit. And then the dividend paid is 4 ringgit. So this dividend is already calculated for you, right? The dividend going to be paid to the preference shareholders is 4 ringgit and 65 cents per share, right? Sometimes the question will give you in the percentage, therefore you need to determine the dividend. Okay, and this dividend, you must bear in your mind, one of the features of the preference shares is what? The dividend amount to be paid to the preference shareholders is going to be a fixed amount, right? So that is why there will be no growth, okay, in dividend, okay, in the preference shares dividend, okay. No growth. That means growth is zero. So every year, the preference shareholders is going to receive or will receive the same amounts of dividend. So that is the advantage for the preference shareholders as compared to the ordinary shareholders. Okay, where the ordinary shareholders will receive the dividend, right, depending on the residual amounts of earning. That is the balance of earnings left. If the balance of earnings left, okay, the balance of the earnings is smaller, that means the dividends amounts will be going to be paid to the ordinary shareholders also will be low or small. Okay, what else? So issuing the preference shares, again, the company has to bear with the flotation cost, same as the irredeemable bond here. What is the flotation cost for issuing the irredeemable bond here? That is 20 ringgit. It's already calculated for you. But for the preference shares, the flotation cost is determined by what is it? Depending on the market value per share. So that is 2% of the market value of the preference shares. Okay. So what is the market value of the preference shares? 120. So therefore, the flotation cost is going to be how much? 2 ringgit and 40 cents. Okay. Right. What about the betul 2% 120, 2 ringgit 40 kan? Okay. And then another types of the of the financing component is what? Ordinary share. Or sometimes the question will use the words of common stock or common shares. Depends on the questions. Okay. Right, what about common shares here? It's stated that, right, company will issue ordinary shares or common shares here at the price of current market price of the share is at how much? 3 ringgit and 50 cent per share. So this is the current price. And then issuing this ordinary share against the company has to bear with the flotation cost of 50 cents already calculated for you. The growth rate computed based on the previous year's growth rate in earning per share, right? So the growth rate is not directly given to you. So therefore, it must be calculated based on the earning per share of the company. So how are we going to determine? Later on, I will show it to you. Okay, next, it is stated as well, the ordinary shareholders will receive. Okay, it's stated that Nike is expecting to pay dividend. So that means this is the expected dividend, right? Expected dividend, that is the abbreviation is D1. So that means it's already calculated for you. If it's not calculated yet, so sometimes the question will give you the current dividend. So current dividend, just take note here. Current dividend is D0. So sometimes the question will give you last year's dividend or current dividend of certain amount. And then you are the one need to determine the expected dividend, the D1. So how to determine D1 then? If the question is like this, that means you need to calculate D1, the expected dividend, D0 times 1 plus G. So for example, let's say current dividend is 1 ringgit. So the dividend is expected to increase by 10%. So that means 1 ringgit multiplied by 1.10 because the growth rate is going to be 10%, right? So therefore, the expected dividend is going to be higher than this amount, D0. So that is how we determine D1. But since in this question, it's already mentioned that the expected dividend is 30%. That means next year's dividend is referring to D1, right? Is 30% of the last year earning per share. That is last year earning per share. So we are now doing for 2018. Right. Is it 18? Yes. So therefore 2017 lah kita punya earning per share. Okay, tak boleh lah nak ambil 2016 given in the question. Okay, therefore you can get the value of the expected dividend of how much in this case. Alright, if you have calculated, that means it is equal to 0.252 per share. Okay, what about G? G is not yet determined or given in the question, but the question gives you EPS for year 2016 is 80 cent, right? And the EPS for year 2017 is 84 cent. So using this information, then we can calculate the, right? We can calculate the G. So how to calculate G? Right, earning per share last year, 80 cent, This year, I mean 17 lah. Year 2017 is 84. Okay, minus 80 cent. Then you divide by 80 cent. Okay, and don't forget to multiply by 100. Okay, so therefore you will get 5%. So this is the growth rate. Okay, tapi untuk this one, dia dah kira, dia dah beritahu expected dividends going to be this one, 30% of EPS 2017. Therefore, we simply use this one. Okay, so having this information, then we can proceed. Okay, right. I think we can simply proceed. Right, calculate the cost of debts. Right, the question is asking you to calculate the cost of debts. So since the debt is irredeemable, so therefore we use this formula. Otherwise, if it's a redeemable, that means we are going to use interpolation method. So we ignore that method because it's not relevant here. So therefore, the KD equals to what is the interest amount? Since the interest rate is 8%, then you have to multiply by par value. This one I already mentioned in the lecture. Okay, where right the interest amount must be paid must be based on the par value or nominal value. Sometimes the question will use the words of par value, nominal value, or principal amount. Okay, so in this case, the par value is 100. So therefore, the interest amount is going to be 8 ringgit. So therefore, you can simply take the annual interest amount, 8 ringgit, and you divide by net price. So what is the next price formula? Current price. Okay, you have to deduct the flotation cost. So what is the current price? This one. Okay, so this is the current price, issued price or market value of bond, which is 110. You minus the flotation cost of 20 ringgit. Sometimes flotation cost will be given in the forms of percentage. So we need to calculate lah, right? And then you will get cost of debts. How much? 8 divided by 8 ringgit divided by 90 ringgit. And multiply by 100 lah, because we want to know the percentage. Okay, so therefore you will get the value of 8.88%. So this is the cost of that. Okay, before tax, right? And then again, I mentioned in the slide or lecture before, right? This is the cost of debt before tax, right? So this is cost of debt before tax. So therefore, we need to determine the cost of debts after tax. Why is it? Because the interest amount is treated as an expense, and this is happened before the tax pay, tax payment. So jadi kita kena tolak lah dengan tax, sebab interest lalu record as an expense in the income statement, right? In order to determine the taxable income, right? So interest here before tax. So therefore, we need to minus tax so that we can get the cost of that after tax. So therefore, you can get, right, 8.88%. Alright, and you can multiply by what? Okay, so we don't have enough space here. Let me route this part. We go to another part. Okay, now, here. Okay, cost of debts after tax. So it's up to you how you want to calculate, but the shortcut here is cost of debts before tax. You multiply by 1 minus tax rate. And that is 0.88 multiplied by 1 minus, let's say tax rate in this case is 24%, right? So 0.24. So you will get the cost of debts after tax equals to how much? 6.75%. Okay? Right, atau you nak buat cara panjang boleh lah. 8.8%, right? 0.88% multiply 0.24 dapat value tu, lepas tu 8.88% minus dengan value yang dapat tadi. Dapat juga 6.75. Okay, tu panjang sikit lah. Okay, next one. We go to the next question. Calculate the new preferred stocks, cost of debt. Okay, this is the information that we have gathered for the preference shares. So what is the formula? Preference shares again. Okay, saya go to the other page now. For preference shares, right? Shares ni is part of the equity, right? So we know that equity, right? Cost of capital for equity, right? Kita boleh guna two methods, right? Dividend growth model, and also we can use the CAPM model, CAPM. Tapi we leave this because it's not applicable here. Kita go to this part. So dividend growth model, I already explained to you. Hopefully you have seen the videos, right? The formula. The reason we use this dividend growth model, we want to determine the price of the share. Okay, the current price of the share. which is, right, D1 divided by KE minus G, right? But then, right, we are in the calculations or in the process of determining the cost of capital. So the cost of capital is referring to KE. So this is actually cost of capital. Okay, so we want to determine cost of capital, equity, E tu. Therefore, we need to rearrange this formula. That's why the formula come up like this. Sorry. Right? Jadi kalau main dengan formula ni, finally dia akan dapat formula bentuk ni. Okay, P0 and plus G. Ini you kena buat sendirilah. Right? Ini saya tunjuk final je. Jadi main dengan formula ni, you akan dapat finally this one. Okay. Alright. Here, bila kita deal dengan preference shares. Bila deal dengan preference shares, mentioned earlier that preference shares, dia punya dividend amount of payable adalah fixed. Right? Dividend payable to the preference shareholders is actually fixed. So bila fixed, maknanya every year the preference dividends to be paid to the preference shareholders going to be equal, no growth. Takkan ada kenaikan sebab kita dah set dah dalam equity certificate tadi, preference share certificate, dekat situ kita dah state inilah dividen yang you akan terima sebanyak RM4.65. Right, per share. Jadi every year dia akan terima yang ini je lah. Okay, right. So therefore, kita takkan ada growth lah dekat sini. G dia adalah kosong. Therefore, growth rate dia will be 0. So no need to put here G in the formula. So that's why dalam formula tu tak ada G. Okay, and then again here D1. D1 kita tahu what's the meaning of D1 or what D1's for here. D1 here is for what? Expected dividend. That means we expect the dividend is going to change every year. Right? Increase or decrease, right? But here the dividend is fixed. Therefore, we are going to use the same dividend amount. So therefore, no one lah. So that's why with the you nak kira cost of preference shares, cost of capital, which is KP for preference shares equals to D divided by current price of the preference shares. But here in this case, we are issuing new shares. Bila issue new shares, company has to bear with the transaction cost, that's so-called as what? Flotation cost. So therefore, company has to minus the flotation cost. Therefore, the company will get the net price here. Net price of the shares. Okay. Right. So again, formula still the same, which is current price of share. Tadi kita kata current price of bond kan? Ni current price of preference shares minus the flotation cost. Okay, so therefore, when we want to calculate cost of capital for preference shares, so what is the dividend? Dividend is a fixed amount, RM4.65. You divide by what is the flotation cost. Flotation cost stated 2% of the market value. Okay, kita dah tahu. Flotation cost is 2% of the market value. What is the market value? 120, which is equivalent to RM1.40. So therefore, current price is 120. You minus RM2.40. Therefore, you multiply by 100. So you will get how much? Berapa persen? You will get 3.954%. Okay, 3.954%. So this is the cost of capital for preference shares. Right, you can, the denominator here, it's up to you. Sama ada nak guna cara ni ataupun kalau you look at the example solution, you can use this way. Okay, whereby RM4.65, this is for the KP again, right, divide by 120 multiply by 0.9 liters. Sama je. Ni shortcut lah. Okay, sebab 2% tadi of the market values kan, flotation cost tu. So again, you akan dapat juga dekat sini berapa 120 minus 240, 11760 cent. Kat sini. You akan dapat 11760 cent. Sini pun you akan dapat 11760 cent. So it's up to you whichever you want to use. Okay, as long as you know or you do it correctly. So this is the cost of capital for preference shares. Okay. Right. Any questions so far for bonds or debts and also for the preference shares? No? Okay, now we go to the ordinary share. Okay, before we go to ordinary share, the question is asking you to calculate part 3. Okay, the cost of capital for internal equity. So bila dia kata internal equity, that means it depends on the internal fund. So there will be no issuance of shares. Alright, so that means there will be no flotation cost involved. Alright, so no flotation cost involved. So therefore, right, again, we are talking about equity. Right, the formula, right, so kita guna juga formula yang saya tunjuk tadi, iaitu bila you nak cari cost of equity here, KE equals to D1 divided by P1 plus G, right. This time kita kena ambil G tu. We need to consider or to need to take into consideration the growth rate here because the dividend amount payable to the ordinary share is going to be changed. It's going to change every year. Why? Because it is depending on the amounts of residual or balance of earning. That's why kita consider G. That's why kita guna D1 because expected dividend is going to be different. Okay, so how are we going to deal with this one? D1. So again, already shown that is current dividend times 1 plus G, right? Divide by, so sorry, this is P0, not P1. The current price, P0 plus G. So since there is no flotation cost, that's why kita guna P0. Still okay if you want to put NP0, but you must alert lah, right? And you must aware that this, when you are calculating for internal equity, that is KE, cost of capital for internal equity, which is KE, right? So the price should be the current price, right? No flotation cost, so no need to minus lah. Kalau you guna NP, takut you confuse kan? It's up to you lah, okay? Right, so how are we going to determine the KE then from this question? So again, the dividend. How to calculate dividend? So it's stated that D1 is stated in the question that 30% of the what? Last year's EPS, right? Okay, so which is last year EPS adalah yang 2017 punya lah, which is 84 cent. Multiply by 30%. So therefore, what is the expected dividend for this calculation? Tadi kita dapat 0. Berapa tadi ya? What is it value dia? 0.252. So having this, terus substitute these figures into the formula. Okay, D1 is 0.252. You just divide by no flotation cost. Straight away, you take the current price, which is the current price of the stocks is 3 ringgit 50 cent, and you plus with the G. What is G? 5%. Kita dah kira tadi. Okay, which is 0.05 or 5%. So therefore, you will get the discount, sorry, cost of capital for the internal equity 12.20% plus or 0.122. Understand? Okay, we go to the next part. which is the cost of capital as required in the question for the new common stock, right? Cost of capital for new common shares or stock. So this is what we call as the cost of capital for external equity. Okay, therefore the abbreviation that we use here is KNE instead of KE. We want to differentiate between the internal and external cost of capital, okay, for external equity and internal equity, then we differentiate by NE here lah. Okay, right. So what is the formula? Again, the same. D1 divided by P0 plus G. But here, when it involves the issuance of new shares, that means there will be a flotation cost. Stated in the question, the flotation cost is given 50 cents. That means the company has to bear with this one. Alright, so therefore, the formula will be NP0. Okay, and you just plug in the figure and put into the formula, which is D1. Kita dapat tadi kira 0.252, right? Yang 30% of last year's EPS kan? So net price, how to calculate net price for the share? Same here, current share price minus flotation cost. So what is current price of the share? It's 3 ringgit 50 cent, right? Okay, 3 ringgit 50 cent, you minus flotation cost of 50 cent. Okay, and you can multiply by plus, multiply plus 5% of growth rate. So therefore, the cost of capital will be equal to 13.40%. Understand? All right. So that is how we determine the cost of capital for each component of finance, right? Financing, which contribute to the capital requirement. Okay, right. Any questions so far before we proceed to the next one? No?
No.
Okay. Next, we go to question B. Question B is suggesting or is asking you to suggest, right? Question B, right, to suggest. You can see the words of appropriate. Okay. Kenapa? Appropriate overall cost of capital. Okay, overall cost of capital, that means the weighted average cost of capital. Okay, and we know that the overall cost of capital can be in two forms. It's either WACC or WMCC. So when are we going to use the WMCC? Bila apa? You issue new, Allah, when you issue new shares. Okay, this one when you rely on the internal or available equity, right? That includes retained earning and also ordinary shares. This one, if you need to issue new ordinary shares. So therefore, you have to use WMCC. Okay, now how are we going to determine which one we are going to use? WACC or you want to use WMCC? How is it? So here, right, we need to determine first the maximum capital expenditure. Okay, so the maximum, firstly, we need to determine maximum capital expenditure. Okay, right. So this is referring to the common equity. Okay, so now how much, right? The retained earning is available for the reinvestment. It is stated in which paragraph? The last paragraph, last point. Currently, Nike has 4.94 million retained earning, and this 4.94 million retained earning is available for or allocated for the reinvestment. So that is the current retained earnings which is available or allocated for the reinvestment. Okay, so how are we going to determine the maximum capital expenditure here? Okay, that is available for the investment. Okay, so first we need to determine the WOF. What is WOF? Weighted, tu kerjaan saya, weighted or the weightage, saya sebut weightage, weightage of financing. Alright, this is actually the percentage of each component's value contributed to the total capital. Okay, you go back to the questions. Let's go back to the questions. So you can see here, okay, out of 100 million here, total is 100 million. So where this 100 million comes from? This 100 million comes from this contribution of each component. That means bond contributes the value of 20.5 million. Preferred stock contribute the value of 14.500 million. Common stock 55.7. Retained earnings is 9.3 million. So you total up this, you will get the total capital U of 100 million. So where the 100 million comes from? From these different components. Okay? Right. So from these contributions of each component's value, then we can determine the WOF. So how to determine the WOF? So we take the, let's say bonds. Kita ambil bonds. Bond equals to how much the value of bonds contribute to the total capital. It is 20.5 million ringgit, right? Contribute to total of 100 million ringgit. Multiply by 100%. Berapa percent out of 100 million? That is 20.5%. That means daripada 100 juta ni tadi, 20.5% is contributed by bonds. Okay, itu maksud WOF kita. Okay, percentage of the contributions of each component to the total capital amount. Okay, what about preferred stock? Out of 100 million, berapa percent is contributed by preferred stock? So it depends on its value lah. So for the preferred stock or preference shares, so how much is contribute to the capital? 14.5 million ringgit. Divide by the total capital available here and multiply by 100%. So that means 14.5%. Okay, so this is the weightage or the percentage of financing. Right? So out of 100 million, 14.5% is contributed by the preferred stock. What about common stock and retained earning? Okay, this part you must take note. This part you have to plus. Right, then we call it as a common equity. So dalam common equity tu you plus dengan retained earning. So berapa total retained earning? 9.3. So retained earning plus common stock. So retained earnings amount 9.3 million. Common stock amount 55.7 million. So you total up, you will get how much here? 5, 10, 10, 5, 6 5, okay, 5. Right, 5, 15
65 million.
65 65 million. So out of 100 million, 65 million is contributed by these two components. So jadi dia punya WOF dia berapa in percentage? Which is 65 million, you divide by 100 million ringgit, so therefore equals to 65%. So this is the WOF. So this is what is shown on the slide. This one. Okay, 20.5%, 14.5%, and 65%. So this is actually WOF. Okay, so once we know this, then we want to determine maximum capital expenditure. That means the 65% here is actually equivalent to 4.94 million. So this is the total, okay, earnings available for the reinvestment. Okay, so if it's 100%, that means 100 divided by 65 times 4.94 million. Dapat tak? 7.6 million. Is it the same? Did you get 7.6 million? Let me calculate. Betul tak?
Betul, madam.
Sama?
Sama-sama.
Okay, sama. Ataupun short form dia senang je lah. Follow the one that is shown on the slide. Atau you want to use this formula. Simply divide 494 million to the weightage of financing, which is 0.65. That's all. Okay, sebab ia akan darab dengan 1 juga kan benda ni. Ni 1 over 0.65. So multiply dapatlah ni sebenarnya. Okay, which is 7.6 million. Same. Up to you. Okay, so this is the maximum capital expenditure that is available for the new project. But then what is the cost of the new project, class? However, the cost of the new project is what? 10 million. Do we have enough? No. Right? We don't have enough because we need 10 million for the new project, the new contract, so sponsorship. Jadi we don't have enough. That's why we need to issue. Right? Issue additional what? Common stock or ordinary share. So that's why we need to use the WMCC instead of WACC. And when you want to calculate WMCC, right, ataupun you want to calculate WACC, kan kita dah tahu ada steps dia, right? At least 3 steps, okay? Right, what are the steps? First, you need to determine the cost of capital for each component. Have we had that cost of capital already? Yes, we already calculated step 1, this one. Inilah step 1 dia yang kita kira mula-mula tu. Okay, the thing is that for equity here, kalau KD kita ambil apa yang kita kira tadi. KP pun kita ambil kira untuk preference shares. Tapi untuk equity kita ada option. Sama ada kita nak guna KE or we want to use KNE. So how are we going to decide? Kita tengok dekat sini lah. Since we are issuing additional common stock or equity, so therefore we need to use KNE. Right. You go back to the formula of KNE. Kenapa kita guna KNE? Bila kita issue additional common stock, kita akan ada flotation cost yang kita minus dengan current price, kan? Kita differentiate benda tu dengan cara kita tukarlah dia punya abbreviations ya. Kita boleh je guna KE, tapi kita tak tahu nanti KE mana nak guna, confused. So kita differentiate lah. Okay, dengan different abbreviation dia. Okay. So KNE lah kita guna dalam case ni. Kita tak boleh guna KE. Kenapa? Sebab it involve the issuance of the additional common stock. Are you following? Let's say kalau kita kira dekat sini 7.6 million and katalah contract sponsorship dia adalah 6 million. Do we need to issue new shares? No. If it's not, that means what? Untuk portion yang ni, last row ni kita tak akan guna KNE. Kita akan guna KE. So kita akan guna 12.2% lah. Okay. So that's why it is important for us to calculate this one, maximum capital expenditure ni. Then kita kena compare dengan the cost of the investment. Cukup ke tak? Kalau tak cukup tu yang kita kena issue additional involved flotation cost. Therefore we need to use K and 13.4%. So in this case kita guna 13.4. Alright. Kalau kita kena issue, that means kita tak panggil dia WACC. Kita akan guna WMCC, marginal cost of capital. Okay, so you total up, that means you multiply for each component, dan you dah ada weightage. This is step 1 kan. Okay, step 2 apa? Step 2 yang ni, iaitu kita kira the weightage of financing. Step 2 kita kira WOF for each component. Step 1 kita calculate the COC for each component. So once you get this figure for each component, then you multiply for each component, then you akan dapat the last column here. So this one multiply by this one, you will get 1.384%. Right, for KP, you multiply by WAF and with the cost of capital of KP tadi, then you will get this one. And for equity, common equity, you use 13.4% the KNE because involve issuing of new shares. Then you multiply by the WOF, okay, which is 65% tadi. This one yang kita kira. Okay, and therefore you get 8.71. You total up these three, then you get the total here. So this total is called WMCC ataupun WMACC lah. Okay, so that is weighted marginal cost of capital. Understand or not? Okay, right. So that's why the question, right, state here, suggests the appropriate, the overall cost of capitals. That means you have to decide whether to use WACC or WMCC. Okay, which one? Any questions so far? Any questions? No? Boleh?
No, madam.
Okay, boleh. Clear? Clear eh? Okay. So then, your job here is to do the past tense questions, right? I have mentioned to you which question that we are going to discuss later on. So you are for apa eh? For C for D. This one eh? December 2018, January 18, July 17, June 16. Okay. Boleh try? Boleh eh?
Boleh.
Okay, so we will discuss, right, these 4 questions next week class. Okay. Tapi I really hope that during the weekends, lepas test tu kan nanti dah santai-santai, dah relax-relax semua, tengoklah soalan ni kan. Alright, this is relating to the basic cost of capital. Kita tak cover lagi the advanced cost of capital for the specific project. Macam mana kita nak kira cost of capital untuk specific asset ataupun specific project. Ini in general. Okay, basic je, baru basic. Okay, kita polish sikit, kita upgrade sikit lah later on in next week's class. Okay, for this week, right, please do the past tense questions here. Okay, so since you don't have any questions, I just leave it to you. Right, then, so kita sudahi kelas dengan surah wal-as and tasbih kifarah. Okay. Boleh ya? Assalamualaikum.
Thank you, madam.
Alright.
Thank you, madam.
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 Um,